So today we're going to talk about a stock that is crashing after it reported earnings last night, and this is a very popular stock. And I mean, I think it's on everyone's watch list. I think everyone will agree that this is a quality company. The only question will be is what price you buy it at. And after the crash today, I'm going to talk about if I personally think this is a buy at these sort of levels, and if it's not a buy, what level will I be interested in buying if the stock continues to crash. So I do hope you enjoyed the video. Hit the like button. Let's get started. So the stock that is crashing after earnings is Nike. This was a $122 stock, and you can see in pre-market the stock is down 12%. So this is a pretty big move from Nike going on. Now if you actually look at year to date, that actually does mean it's currently about 3% up, but this will mean that Nike will go negative for the year once the market opens up. You'll be able to hear it's a 186 billion market cap company, so it is a pretty decent size, and you can see it's currently a 37 times earnings, and it does pay a dividend yield of 1.2%. Now, going a little bit off topic, the really frustrating thing to see is that because Nike has gone, or is going to go down 12% today, it does mean that my position in JD Sports has gone 5% down in movement with the Nike, and thinking, well, if Nike's having weak numbers, then JD Sports might have weak numbers, which is a little bit frustrating because it's like the whole Foot Locker situation all over again, because what we've seen from JD Sports is they have only put out very good financials this year. But I guess at the end of the day, JD Sports is still up 27% year to date, which isn't too bad compared to when you look at something like Nike, for example, but it's a little bit annoying that it does keep getting pulled down in sympathy because Nike is going down. Now, when we do have a look at Nike, I think Nike is a quality company. I think most people agree. Nike is a brand that just carries on redeveloping itself. It stays a very popular brand, and at the right price, I think we would all want to own this brand, as it does seem like it'll be a brand around for a very long time. When you look at how popular the brand actually is, if we look at the Piper Sandler Survey for teens, you can see here the top clothing brand once again is Nike at 35%, which is a very good market share. And you can see here from the top footwear brands, it's 61%, and they just continue to hold this market share. I actually asked the kids that I teach the other day, just we're having a bit of fun asking a few questions, and I said, okay, what's your most popular brand? And they all, even I'd say 80% of them said Nike. So the fact that it still appeals to all generations and still gets all the younger generation buying the clothing and thinking they're a very popular brand, signing the right partnerships, it continues to control market share. And I think we all agree, you know, at the right price, we would like to own this one. Now, if you look at the recent update that did come out, you can see why there was a bit of a drop in the stock. So if you look at the EPS wasn't too bad because it did beat by a good amount, but when you look at the revenue 0.5% growth year over year, and actually when you look at currency neutral basis, it was actually down 1%. So we actually have declining revenue on Nike, which is not good. When you are buying a company, you know, you want to see probably at least 4 or 5% revenue growth. Ideally, if you're trading at 37 times earnings, you would expect a premium company. Now, you could argue Nike is a premium company because it's got the premium brand, but even so, you want to see that on the financials. You want to probably see a good amount of growth here, and we haven't got that at the moment. Now, there was a couple of positives in here. Nike Direct revenue was actually up 6%, so direct to consumer revenue is obviously a lot more profitable for them. They cut out the middleman, like a JD Sports, for example. So you can see here that actually did increase, and you can see here that the reduction was in the wholesale, which was down 2%. Now, because of that, it did mean the gross margins did go up, which I think was actually a decent positive actually in this earnings report. Now, something that actually probably will go under the radar a little bit is actually when you look at on a net income point of view, it was actually up 19%, which is actually pretty good. But at some point, the problem is that you do need to see revenue growth inside the company. And the thing is that when you look at Nike, yeah, it's improving its direct to sales and it is making cost cutting, but we do need to see growth return into the company at the moment. Now, the thing is, and I've got to say, when you look at Apple as well, you know, Apple's had the same situation this year. You know, when you look at their numbers, revenue was down 5%, net income was actually down. And you look at April's quarter, down again. You look at July, pretty flat. You look at the recent quarter, at least they did get net income up in this quarter, but same thing, you look at Apple, and you do think at 31 times earnings when this one going to have a bit of a pullback, you know, compared to Nike's, you know, going to be down for the year, but yet Apple still goes up 55% year to date, which is absolutely crazy. I know if you Apple fanboys will hate me sticking that on the video, but I was just looking at Nike going, it's funny that this is now going to go negative on the year, but Apple is very similar kind of company. Obviously not from a what they sell point of view, but from the numbers point of view, very similar. But this is up 55% today, and Nike's going to go negative for the year, which is crazy. But the big thing why Nike did drop is the outlook. So when you look at the outlook, they said that they now expect full year revenue to grow approximately 1% compared to the prior outlook of mid-single digits. And that obviously includes the second half of the holiday season. They said they are seeing a hard macro environment, but they are expecting gross margins once again to improve, but they are planning on cost cutting, as you can see here, to try and save more money, to still try squeeze up the profitability side of it. Now, the macro side of it makes sense. We've seen this in a lot of companies. We only have to look at Foot Locker, which we actually mentioned early in the video. Very similar company, they're seeing weak demand as well. So it's not just a Nike issue, we're seeing the consumer be a little bit more cautious about the spending, and that's what was kind of the high interest environment has done. We've kind of got away with avoiding an official recession, but we are starting to see the kind of weakness kicking in here with a few companies, and Foot Locker and Nike are very similar. So we're seeing that happen. Now, like I said, I don't think Nike is going to ever be a company that struggles. I think this is just a tough period that we're seeing a lot of companies in this high interest rate environment suffer for, and they're suffering on a sales point of view. And when you look at analyst forecasts, for example, if you look at the track record as well, by the way, absolutely amazing company on driving up the the profit and revenue, as you can see here. When you look at future growth, you can see analysts are actually forecasting once again the company to go back onto revenue growth and profit growth. And as well as that, you're sitting on a company with a very good balance sheet. So I think that we look at this and go, there's a problem with the sales at the moment, and we can understand it because there's an environment going on. But I think when you look at the valuation point of view, when you've got a company that's doing this sort of numbers, I personally think 37 times earnings is a little bit high. And when you look at Nike, I don't know if it's just because I'm getting a bit of an older investor now, but for me, I've always gotten used to Nike being 20 times earnings. So if you look at Nike's history, 2010 is about 20 times earnings, went a little bit higher during 2016, had a bit of a pullback, but always sort of had around about 20 times earnings, apart from this little bump up because of one-time charges. And then recently it's kind of gone to a premium of 30 times earnings, well, even 37 times earnings. Personally for me, I'm not used to this with Nike. I think that this is a company that is a very good quality company, and I would expect to pay, if I can, the market average of around 20 times earnings, what it normally trades at. And when you look at a PEG ratio, once again, this looks, when you start factoring the growth, once again, this looks a little bit on the higher side. Currently it's a 4, normally it's around about a 3.29, which once again says to me that this is around 20% higher than what it normally is on a PEG ratio. So for me, I think this is a good quality company, and if they're going through some weakness, I would expect that to be reflected on the share price, which it is starting to do. But even though it's starting to have this reflection on the share price, I still don't think it's historically cheap enough to what it should normally be. And when I look at the ratios that Nike is currently trading at, for me, I would have to see Nike go lower. When you look at a P ratio, if you look at a PEG ratio, both of these metrics are saying this stock needs to be cheaper to what it historically is and would justify buying into this stock. We all want to own great companies, but we don't want to own great companies at expensive prices. What the aim of the game is with investing is to buy a great company at a cheap price or a great price. And I think we've got a great company with Nike, 100%, but I still think that even when you look at this stock price and where it's going to go to today, I still don't think the price is good as an investment. I don't think this balances out your risk to reward. And ultimately, I think like when we look at the PEG ratio or even a P ratio, both of them suggest the stock would be a lot better at around 20 to 30% discount. And I personally think that is where I would be more interested in buying the company. A 20 to 30% drop on the stock would put it back in towards the $80, $90 range. I think 80 is a good price for Nike personally. Now we have seen it actually get there, so people will say, well, it's never going to get to $80. It can. It did it pretty much in September 2022, and if you actually look at September 2023, it was starting to get close there once again, and that would also put the stock back to prices it was at just before the CV situation. And how many times have we seen stocks in the last 24 months get back to prices they were at CV situation? It happens. So for me personally, I think it's a great company, and I would like to own Nike, and I think most people agree it's a great company and they would like to own it. I think you've got to have a better risk to reward here though, in my opinion. and it's on a watch list. If this downtrend continues, if that negative sentiment now gets built around Nike and we start seeing the stock push another 20-30% lower, which can happen. It can happen very quickly. It can happen over a month, 2 months period. In fact, it can happen in a day. I don't think it'll happen in a day, but if we have that negative sentiment build around Nike and we do see that push into the $80 range, you'll see me a buy of Nike. And that's where my price target is for Nike. I think it's now one to add to the watch list and see if this drop does continue. But even though with the drop today, I still think it has to go lower for me to be a buyer, personally, in my opinion. So that's the video today on Nike. I hope you enjoyed the video. Let me know what your thoughts are on Nike. Are you a buyer? Are you a shareholder? Are you just someone that doesn't want to own it? Let me know in the comment section. Hit the like button. Subscribe if you're new around here. If you can, if you get me to 15,000 subscribers by Christmas, I will drop a live stream on Christmas Eve. So that's a little bit of a challenge of you guys. If not, I get to have Christmas Eve off. So we'll see what happens. But hope you enjoyed the video, guys. See you in a bit.